Buenos dias. Oh no, it's buenas tardes at this point. I am a little delayed here. I apologize. All right. The a different sound setup today. Let me know how the sound is. All right. How's the sound? Hey everyone. Oh, and the image looks blurry. Okay, so if the image is blurry, always refresh. Make this a little bigger. All right, so we had a test last week. Great. So we had a test last week. I want to finish marking those hopefully today or tomorrow, and I'll send you. I'll put the grades up at the front of the Moodle or the top of the Moodle platform. And otherwise, I wanted you to spend this week looking at the video I posted for last week. I know we had a test on the 21st, but I posted a video. How many of you watched that video? Because I'm just going to pick up from the end of that. So that was a pre-recorded video. That was to keep you busy last week. How many of you saw it? Am I buffering? Not good. I'm not sure why it says the stream is healthy, but it looks like it's buffering. Okay, so the question was, how many of you watched the video I posted? No one. All right, so there was a posted video for after the test for last week, and it was under Unit 3. I wanted you to get started with Unit 3. Oh, good. I'm glad, Alejandro. All right, so you knew you had to do it because it's scheduled for due today. So you need to watch that video, and now I'm going to finish off the tail end of that video. And it looks like we have a buffering problem. Probably need I probably need the connection. Connection. How's this? Yeah, we're back. Just a few feet and the connection improves. All right, so probably we're going to lose the chat because that buffering that happens. But at least we'll have the video. Okay, great. Anamaris, thank you for watching. All right, so I'm going to finish those notes off. So anyone who didn't watch those, you're going to have to go back and see it or watch that video. And this will be the complement or the tail end of the video, okay? And I'll do a little bit of tail end of the lecture for Unit 3. And I will do a recap at any rate. I'm trying not to lose any time because we were robbed a lot of time. Seems because of different kinds of administrative issues. One moment, please. I am just looking for my pencil. All right, so to this point, what we discussed was the different kinds of techniques for evaluating projection of cash flows. And we started, even before this unit or this topic, we started with the NPV. An NPV gives you a dollar amount, and that dollar amount represents to you the profitability, the net present value of a project. Obviously, it depends on the estimates that you made and the assumptions you made, but essentially it gives you a dollar amount, and that dollar amount should exceed zero for you to justify investing in a project, pursuing a project. After that, then we started saying, well, what NPV requires a number of assumptions, and one of those are that you have the best information to determine the discount rate for the project, like the interest rate you're going to use in your valuation of the project. What if you don't have, what if you're not convinced that that's the right discount rate to use, or you have a range of discount rates? So there's other ways to look at a projection of cash flows to evaluate them. And I talked about the payback period, which gives you a number of years. So what do? You use that number of years to compare against how many years you, if you're the owner or you're in charge of the firm, or if you work for somebody in charge, you determine how many years it takes to recover the investment cost for this project. And you compute a payback period. And then compare that to a threshold, like maybe you only want to pursue projects that pay back in 2 years' time. So in that sense, you're not going to pursue projects that pay back take 3 years to pay back. And so we talked about some problems with that. And one would be, well, you're not even thinking about the time value of money after spending the last month and a half talking about time value of money. So I introduced the idea of the discounted payback. That also gives you a number of years, but you discount the cash flows and use those to compute how many, the accumulated discounted cash flows, and say, well, how long does it take for a project to pay back? So that helps incorporate the time value of money concept, but it still is deficient because this approach fails to look at future cash flows. And whereas as compared to the NPV uses all cash flows to value a project. The payback period, or the discounted payback period, just uses the number of years it takes to recover costs. So it doesn't use all the cash flows. Now, beyond recovering costs, you want to make profits. Well, what if in the future, like beyond recovering costs, you realize a huge windfall, millions of dollars more than any revenues before that? And you're not even considering that if you don't consider future cash flows. So that we see as a limitation of the payback period rule. Also, what if there's a huge loss in future years? You want to consider that, not just recovering costs, you want to consider how that's going to affect your long-term profitability. So that's why if anybody's to use the payback period or discounted payback period, they'd use it together with the NPV probably. Okay. The other problem we mentioned with the payback and discounted payback period are that the number of years to say recover costs, we need to recover costs within 2 years. That threshold or that setting is rather arbitrary. It's subjective, right? It's not something as objective of saying, oh well, all projects that exceed NPV of 0 should be accepted. That's very objective. For the payback period, the two years setting or 3 year setting is quite subjective, and depending on new information, it might vary. So the arbitrariness makes it I guess in a way, not as easy to use or not as straightforward to defend as the NPV rule. The other rule we learned about was the internal rate of return. And this is where we are here. And the internal rate of return gives you a percentage when you calculate it. And it's actually, it addresses the issue of the calculating the NPV and not knowing the discount rate. So if I don't know the discount rate and I still want to use, the idea of using all the cash flows, the time value of money, what I'm going to do is try and find the break-even discount rate. So what would be the return if the NPV was 0? So doing that, I solve for the internal rate of return, where the discount rate where the NPV is 0. And from there, I say, well, this will represent, the internal rate of return represents like a return on investment, which I compare to my discount rate. And I say, as long as it's higher, the return on investment exceeds the required rate of return for the project, the required rate of return for investment, then I should proceed. I also talked about the internal rate of return for finance projects, which the response is in the reverse. Now, you guys are going to have to look at the video to see that. And then I left off towards the end of the video looking at projects with multiple IRRs, right? So let me just recap that, because that might be, oh, isn't that interesting? I have one a page. I guess I made those bigger. Okay, this is the 2 slides a page. So the rule is, when you have okay, let's do it from here. Let's go from here. Can you see that? It looks kind of bigger. Okay, so let's summarize this. All right, so we'll say an investment type project is where the initial cash flow is negative and subsequent cash flows are positive. That's only one sign change in the projection of cash flows. Then you have what's called an investment project. And when you have an investment project, your interpretation of the internal rate of return is as a return on investment. And as long as that exceeds the required rate of return that you're using for your project, then you should proceed with the project. The opposite set of cash flow, so the first cash flow as a negative and the other one's positive, sorry, the first one, initial cash flow is positive, so you're getting money up front to produce a product or to offer a service, and then the subsequent cash flows all negative, because you are going to disperse of funds, you're going to buy the inputs to production, or you're going to hire the employees to offer the services, right? Those will all be negative, and there's still only one sign change. So it turns out that that's just the opposite of the investment project, and rather we interpret the internal rate of return as like we call it a cost of borrowing, right? Financing, or the cost of financing. And we really need the required rate of return to exceed the cost of financing to tell us to pursue the project. So those are the two kinds of patterns that we analyze. So you're going to have to go through the video. I'm actually summarizing here, and I do have a summary sheet as well in the notes that you can look at. What if you have more than one sign change? So here's an example: cash flows, an investment in year 0. And you can think of all these in thousands of dollars. So this is like, you can think of this, $260,000 investment. I just use small numbers and drop the zeros, okay? Make it simple. So invest $260,000, and then these are the returns. You can think of them $1,000 or whatever, and thousands of dollars, or just these simple numbers. And then what happens is there's a loss, right? We see a loss in the 4th year of $340. So are the returns in year 1 through 3 enough to offset the investment and the future loss? Well, this is going to create, in terms of solving the IRR, a polynomial with where there are 2 sign changes. The pattern will actually look like this, like a parabola. Okay, so these are the possibilities. Let's look at the extreme cases. Let's say the parabola is always above this line for the NPV profile. So this plots the discount rate, this plots the NPV. So the NPV profile is always a positive here. So what should we do? There are no IRRs, but the NPV is always a positive. So what should we do? What should be the decision? This NPV profile was generated by taking the equation of the internal rate of return that looks like this. It's basically NPV equals 0. And changing the discount rate to generate these different NPVs. Right, so Julito says that the NPV is always positive, so we should, no matter what the discount rate is, this is a positive NPV project, we should always accept the project. We should always pursue it. In this case, if this is the NPV profile that's generated, then the project is always has negative NPV, negative as an NPV as a negative, so it's less than 0. You should never pursue this project. And now these are the other cases here where, in this case, the parabola cuts in 2 places. So you have 2 IRRs, and how do you deal with that? What should be your decision in this case? So in this way, we can compute IRRs, and they're going to give us, it's going to help us determine intervals where the NPV is positive. So we are using the NPV rule, but without a strict determination of what the discount rate is, we can determine a range of returns. Or sorry, we can determine a range of discount rates that would lead to positive NPV. So what should be the decision here? No thoughts? Right, so you want to invest where the NPV is positive. So that will be whatever this number ends up as, would be the discount rate. So as long as the discount rate is greater than this value, you should invest in the project, or between 0 and this value, that's where the NPV will be 0. We don't consider a discount rate less than 0. It's not going to be the case that a firm will use a required rate of return that's negative, right? So we cut off at 0. So I accept only if the required rate of return is less than IR1 and greater than 0. I didn't write the details there, but you should know that. Or the required rate of return is greater. And it's because when you look at the stream of cash flows, the fact that you have a really relatively high negative number here, you want to diminish that. You like high discount rates, right? You want to make that worth nothing by the time you make it, when you consider it in the present value. So if you're to discount this, you want a high discount rate to diminish the impact of that. So that's favoring high discount rates. And this 250, that pretty much offsets this negative investment, or this investment cash flow. For that case, you want low discount rates because you want to keep 250 strong against the 260. So that's why you have extremes of low and high discount rates. That's how that works. All right. All right, so let's see. And then we could have something like this. And what would be the decision here? I mean, I've written it down, but I want you to think about it. So I'm just looking at patterns. We're going to talk about, well, you're going to use, you're going to attempt to solve problems like these. I'm just giving you an overview. So here, you're going to accept between the range of values. Exactly. Very good. Okay. So you're only going to pursue the project if the discount rate the firm wants to use. So that's going to be the rate of return they require for investing in this project is between the two. All right, so that's how we deal with multiple IRRs. So what you have to do is create an NPV profile for the cash flows, identify the internal rates of return and the acceptance region. There's an assumption made when you do this that the cash flows over time will all be reinvested at that internal rate of return. Just to let you know, there's lots of assumptions that go into this. So you might want to do this several times using different sets of assumptions. The last case I want to look at, and I did mention this before, what if your parabola looks like this? So it's going to hit somewhere over here in a negative, at a negative discount rate. But as I mentioned earlier, firms won't pick discount rates that are negative. So you can say as long as the discount rate of the firm is between 0 and this value, whatever it is, then you should invest in the project. That's right, Adamaris and Lito. All right. So those are the kinds of problems I solved in the notes. And did you want to take a screenshot of that? Sorry. Or reproduce that in your notes. So it is up to you to get organized and print, your notes, or print the pages that are, give the information you need and use the rest for reference. That's all up to you. So we do this again when there's more than 1 or 2 sign changes or more. When there's 2 sign changes, there's up to 2 IRRs. So I say up to because here there's 2, there's 2, here there's none, and here there's only 1. Okay. So up to 2 IRRs. So if you have 3 sign changes, there's up to 3 IRRs, and you just got to look for them. The best way to look for them is using the NPV profile. What will happen if you have 3 sign changes is that this thing will loop up. That. So you would have learned stuff like this about parabolas and polynomials in pre-calculus classes. All right, so let's get back to where we left off, where I was talking about this example. So what I said here, and it's important to look at this, is until this point I was discussing what are known as independent projects, like just evaluating a stream of cash flows estimated for a prospective project and determining whether we should pursue it or not. Well, the fact is, often you have to choose between projects, right? So you have to pick one out of many. When picking one out of many, you should go with the one with the highest net present value. And so the question arises, well, can't we just go with the one with the highest IRR? Well, yeah, seems like that if you have it just seems like that should be sufficient for an investment type project, right? I'm going to pick the one with the highest return. Well, in fact, that's not the case. And here's an example. So just in this example here, it looks like, so this is project A, this is project B, and it's not related to these over here, okay? This is just another set of imaginary projects. And let's say the NPV profile of A is this way and the NPV profile of B is that way. Which one should I pick? Which one should I pick? Right, Louise, that's right. B is higher. It's a higher NPV. So don't forget, I mean, we are analyzing, looking at the IRR. We've been discussing it, but the NPV rule is consistent, right? It should continue to be applicable. IRR depends on NPV, in fact. So yeah, at B, well, no matter what the discount rate, B will have the higher NPV. So pick B. Well, that's going to be the case as long as you don't have what are called problems of timing or problems of scale. And what you will have if you have a problem of timing or problem of scale is overlapping projects. So this is A, the bolder line, and the dotted line or dashed line is B. Now they overlap. So it looks like A is better up until here, and then B is better after that, right, with the higher NPV. So that happens if you look at these cash flows. A has a different timing of cash flows as B, right? Okay, and also is a little bit higher of an investment than B. It's a little higher scale project. So A favors low discount rates so that the 200 remains pretty high to offset the initial investment. So that's why A is preferred over here with the low discount rates. B is preferred for the high discount rates because it doesn't care too much about the 50 out here and really wants to retain the power of these, but they're so close in the future, and 250 is a smaller amount that it doesn't mind higher discount rates relative to A. So that's why you pick B after this point. So when you have a problem of scale and a problem of timing, you'll have overlapping or crossing NPVs. And how do you look at that? How do you compare those? It's very confusing because if you just looked at the IRR, it looks like you should pick B because that has a higher IRR. But that's not necessarily the case. That's not the way to analyze this. Instead, what you should do is calculate what's called the incremental project. The incremental project is analyzed as comparing now I'm going to do this. I'm going to subtract A minus B. Is that what I do over here? Just making sure. Yeah. Okay. I want to subtract them. I create something called, well, I'll write it like, so project A minus B is actually virtually subtracting and collapsing these into one set of cash flows where the first one's a negative because we have more intuition for an investment type project. So let's subtract A cash flows with B. So that would be negative 350 minus negative 250. So in other words, we're adding 250 and we get negative 100. Did I just make that super small? Hold on. Maybe not. It looks a little small for me. So negative 100. And then 50 minus 125 is negative 75, right? And then 100 minus 100 is 0. 150 minus 75 is 75. And then 200 minus 50 is 150. So these are the cash flows. These are the cash flows. For the incremental project, and these are the cash flows for project A over B. That's how we refer to the project. In other words, pick A, not B. And if we're to pick A over B, then this stream of cash flows should have an IRR that exceeds the the required rate of return, just like an investment type project. Like notice that the first cash flow is negative, but even the next one. So the first two cash flows are negative and the rest are positive. It's still one sign change. It's still one IRR. So to find what the IRR is now, you just you ignore these. So you've collapsed them into the new project, incremental project, and that's what you look for the IRR of. So you put those in your calculator and you get a number. What number do you get? So let's go into the CF keys and clear work. So I'm going to enter these values here. Oh, let's do the split screen. All right. So I want to enter these values with 100 negative. Enter down. Then 75 negative. Enter down. And there's only one of those, so I continue. 0, enter down, down. 75, enter down, down. And 150, enter down, down. And I compute IRR. What did I do wrong? Compute. There. So the answer is 8.07. Does anyone see that again? So Adamaris, yeah, this is kind of like a exceptional case, but as long as the first cash flows are negative and the rest are positive, it will still have the pattern of an investment profile, NPV profile, so it works. Oh, very good, Sandra. Okay. Okay, so the answer is 8.07. And that's where we left off, the beginning of the class. So 8.07 would be this bold line. That is actually the NPV profile for the bolded values. and it represents choosing A over B, which we already discussed, as long as the internal rate of return, 8.07, is higher than the discount rate, you should choose A. Otherwise, you choose B. So it's the same thing I said before, but I've done it in a way to calculate this magical number, right? We wanted this one. That's when it switches from A to B, and we got it. All right, so you have the video to review that, and then understand the IRR for both independent project analysis and mutually exclusive project analysis. So this stuff is not hard once you learn the rules, but you should practice, so you practice the rules. So back to our list of different techniques. The last one is called the profitability index, and it gives you a ratio of benefit over cost. So the benefit is going to be a present value of future cash flows, and the cost is going to be your initial investment. All right, questions? Let's look at the profitability index now and talk about how it differs or improves our analysis. So each of these are known as rules, but I'll just refer to the metric, the measure that we make, right? So the profitability index is the present value of future cash flows divided by the initial cash flow. Let me check that you have this set of notes, because this looks a little different than what I gave you. Let me see. No, it's the same. Okay. Okay, so it needs to be an investment type project to do this. So the CO symbol is just the absolute values of CFO, because CFO would be an investment. So that would be a positive. Now this calculation is basically getting the present value of future cash flows. If you have the NPV already calculated, add back the initial investment, and that will be the present value of future cash flows, and then divide by the initial investment. All right, and what do? You compare that to 1. In other words, the benefits exceed the cost, right? If you're ranking them, to pick the best one, you should pick the one with the highest PI. However, mutually exclusive projects can still have a problem when you have to pick one, just like the IRR. So we'll have to analyze the incremental project. Right? So it might suffer from problems of timing or scale of the project. So if you don't understand what I mean, go back and watch that video about timing problems and scale or budget, low budget, high budget. Okay, so what's nice about profitability index, however, is that it's easy to understand and communicate. It gives you the correct decision when evaluating independent projects. And I have to say, as long as you use the incremental project analysis, it'll also give you the right answer using the incremental project analysis for mutually exclusive investments. In addition, however, it may also be useful when you have capital rationing. So in this unit, I mentioned three goals or three approaches or scenarios of determining whether you accept a project or not. So one was independent project analysis scenario, where accept all projects that satisfy a certain criteria. The second was mutually exclusive projects, where you pick one. And capital rationing, where you have so much capital to invest in projects, but maybe not all of them. Okay, so when it comes to that scenario, capital rationing, the profitability index has a keen ability to give you the right answer. Okay, so I'll give you an example of that. But first, let's calculate the profitability index. Try it for here. What's the NPV of this project and what's the PI? Okay, some answers. Okay, so what happened here? What's going on? Not sure what challenge I'm having here. Okay, there you go. So here you have the NPV, 180.99. To find the PI, you need to add back the initial investment, which was 1100, and then divide by 1100 to get 1.2. So you should accept the project. Oh, Adamaris, you did something wrong there. So try that. The other way to do it, so let me show you to do this on your finance calculator to get the present value of future cash flows. I mean, you could do it this way. You could just do, and like in your test, you have to write all this out, right? So if you just wanted to do present value of future cash flows, it's just this part, right? So you could get that out of your calculator. Okay, so let me show you. So this is, oh, let's do a split view again. Oops. All right, so what I'm going to do is go to my CF keys, clear it, and now put a 0 in there. I don't want to put the initial investment. I just want the present value of future cash flows. And then, oops, then as the first cash flow, I put 500, enter down, and then 1,000, no, one of those, sorry, go back. So one of those, enter down, and then 1,000, enter down, down, down. And now ask for NPV, make the interest rate discount rate 10%, enter down, and compute. And there you get the numerator, present value of future cash flows, and then simply divide by 1,000, or 1,100, sorry. $1.16. Oh, Adamaris, you did get it right. I saw the 1.6, but it's 1.16, which is 1.2. Very good. And because it's like you could see that as a 20% improvement or a 20% return, or 1.2 in terms of ratio, it exceeds 1, so accept the project. Okay, so you get more than you invest, right? The benefit exceeds the cost. Okay, so now let's look at the scenario that I mentioned, capital rationing. There are going to be 3 projects to choose from, and you have $10 million. $20 million, sorry. Which one should you pick? So as I mentioned, there's independent, mutually exclusive, and capital rationing project analysis. We're going to look at this right now. So we have $20 million, and these are the 3 possibilities. We can either choose project 1 or 2 and 3 together. Looking at this information, which one should you pick? I put some other calculations there too. Am I still in the split view? No. How do you conclude with the information I've provided? No comments? No idea? All right, so I provided all the information there. I'm not sure why you're hesitating, but okay. So the decision is going to be to choose between project 1 for $20 million investment or projects 2 and 3 together that uses up to $20 million. Now, when I compare using the NPV, it looks like project 1 is has a $50, well, these are in thousands of dollars, so $50,000 return, NPV, and that's greater than 0. And picking project 2 and 3, I can just add those together to get the NPV of project 2 and 3. I can write that here. You'd have to sum them, and that would be whatever the number was I had there. 6865. So that together is higher than 50.47. So using the NPV rule, you should pick project 2 and 3. So you have an answer, and that's great. What is the profitability index measure do for you? So these are the profitability index of all 3 projects. If I put them from highest to lowest, the highest is project 2, the second highest is project 3, and then the worst is project 1 in terms of profitability, the profitability index. In fact, and these are calculated, remember, just this future value, present value of future cash flows divided by the initial cash flow as a positive. And that's where these numbers come from. And you see, just calculating this column, already I see the best project is project 2. The next is 3. So those two are on the top. So just ranking them, I get my answer right away. So that's interesting, right? So the PI actually ranks them so that I can pick the top projects. And notice since they add up to the 20 million, I stop looking for projects. So this is a particular advantage for the profitability index and capital rationing projects, and that's what makes it or gives it its strength, right? It's an advantage of using it when you have capital rationing. Okay. And I do all these calculations here, and I draw my conclusion here, saying that the PI index gives you a measure of bang for your buck. So it's because it's per dollar, right? Investment. Right. So have a look at that. Now, I've shown you 5 different, let's go back and look here what I wrote. I wrote it over here, my summary page. I think it's up here. Nope. Where's my summary page? There, my summary notes. Okay, and I do have a summary page on the platform. So 1, 2, 3, 4, 5 different rules or metrics and with rules. And so which ones are more popular? So there was a study done to look at that question. Which one are you actually used by chief financial officers, CFOs? And in a survey conducted like 20 years ago, and I don't know that we have reason to believe it's different today, but IRR was the most popular. And it's because of what I emphasize, the fact that you don't have to have a set discount rate. Using the IRR, you can find ranges of discount rates that are feasible and then consider, well, our discount rate should fall somewhere in that range, so we'll either reject or accept a project. Now notice NPV is not too far behind, and that's probably because these are used in tandem, right? Even though I have used the internal rate of return, I often have to rely on the NPV, where NPV is positive, to determine if I'm going to accept or reject the project. A distant third is the payback period rule. Notice payback period is more popular than the discounted one. In fact, we like IRR and NPV because we use all the cash flows, where payback period doesn't. Although in tandem with NPV or IRR, it offers a different bit of information, right? It tells investors, let's say, in a company you have investors, it'll tell investors when this project recovers its costs, initial costs. So it can be a complementary bit of information. And because it's not used alone or exclusively, it doesn't matter. It seems like it doesn't matter that it's so precise as counting the discounted payback period. That's just a back of the envelope calculation of the years it takes to recover the costs is good enough. No need to get into time value of money issues. And then far, far behind that is a profitability index. Although we find a unique a unique feature of the profitability index. It seems that the other sorts of measures and rules are sufficient to meet the needs of CFOs. So that's an interesting bit of information. Any questions for me? So Louisa is can we have a case where PI rule favors one project, but NPV rule favors another? So you'll see in the exercises that I posted that when you have to pick between mutually exclusive projects, because of that, those overlapping NPV profiles, both the internal rate of return and the PI might tell you a different story. And that's why you have to analyze the incremental project. So when they are different, Louise, you need to analyze the incremental project. Okay? But in fact, NPV rule will always give you the right answer. Like, it does give you the right answer here in the capital rationing decision. It's just that it's neat that the PI gives the answer faster. So I didn't have to go as far as what I did here and actually add the cash flows for 2 and 3 together to get the PI of the project alone. It was good enough just to rank the projects, and it gave me the right answer. Okay, so the answer to your question is NPV always gives the right answer. If there's a conflict between PI and NPV in choosing between mutually exclusive projects, then use the incremental project analysis, and you'll find that NPV and the incremental project analysis will give you the same answer, whether you use PI or IRR. Okay, good question. So you have lots of practice, lots of opportunity to practice. Let me show you. So here you have the notes, the summary notes, and exercises, practice exercises, and an old exam with solutions you can practice. And I'll leave that to you. I'm going to link the lecture, the second lecture here, beside this one here, and or underneath. And otherwise, I'm going to leave that to you to work on. Okay, so practice that this week. What I want to get into is that should only take you a week to study. All right. That's why I hope that you would have done it this week. But if you haven't, you still have, like this past week, you still have this coming week. What I want to do, we are going to meet on Tuesday, and I want to continue with Unit 4 on Tuesday. So in Unit 4, we're going to start looking at capital budgeting. So what we've done so far with Unit 3 is learned how to analyze a set of cash flows. Right? We learned more. We went beyond the net present value rule, and I introduced some other rules that are complementary and provide different information to help you evaluate whether to take a project or not. And so you have different perspectives perspectives or angles to look at a set of cash flows. Now in Unit 4, what we're going to do is learn how to generate those projections of cash flows in what we call a capital budgeting analysis, right? So we're going to come up with the cash flows, and that's going to take a bunch of information. So we're going to read through cases, identify income cash flows that are part of investment or investment cash flows, and then we're going to put those together to compute the NPV of the project. I'm also going to show you how to end off with, having the final set of project cash flows. But in general, you're going to learn how to analyze the NPV of the project given the information. All right, so we're kind of going to go a step back. We are just usually going to use the NPV to analyze the project, or the IRR. This was just an opportunity to go a little deeper. Okay, let me look at the question, Adamaris. Okay, so sometimes, so which problem is it? So which question are you looking at, Adamaris? What page are you looking at? Because you said techniques for valuation 2. You mean the exercise? You mean the second exercise, or? So you shouldn't have to change anything. Okay, that one that says number 2. All right, so those are... Okay, you want to look at that together? I can look at that with you. The answers are there. I've given you all the solutions, but let's look at that together. So for this set of projects, I ask you to consider these as independent projects. It means that you're going to just determine if you should accept them or not. Now, the first project is what kind of a project? What would you call that? What would I call it? No comments? So the first project is a investment type project, because the first cash flow is a negative and the rest are positive. So there's one sign change. That's an investment project. The next one, though, the first cash flow is a positive and the rest are negative. That is known as a finance project. So the first one, you put them in your calculator, and I'll just show. So for the test type situation, you will have to write this whole expression out, okay, to show me that you know what the NPV is. Sorry, NPV equals 0 with IRR is what you want to solve here, right? When you do this calculation in your calculator, you don't have to set anything. Just be sure you put the negatives and the positives in the right place. So, and then ask for IRR. And in this case, you get 7.6347 as the IRR. And what do you do with that? You need to compare that to the 10% required rate of return as specified up here, right? So it turns out that this amount, this return is not greater than 10%, so we do not accept project A. In the second case, this is a finance type project for project B. When you calculate the IRR, you get 0. Is that what you're talking about, Adamaris? So for this second project, or project B, you get a 0. That doesn't mean that it's a mistake. It's actually a 0. And in this case, a 0 represents, because it's a finance project, it represents the borrowing rate. And we actually want that to be lower than the required rate of return. We want to be borrowing at a lower rate than our rate of return for the project, or what we require for the project. So that is less than 10%, so we would accept project B. Have I answered your question? Is that what you're having problems with? You shouldn't have to set anything on your calculator. It should just work. Just be careful about the signs, because it will be the case in some calculators that you will get nothing, or you'll get an error because some calculators cannot calculate the IRR. Like, think about this example that I gave here. If you put in cash flows for a project that, let me get that drawing up again. Remember this discussion, you'll get an error if your cash flows give you this NPV profile here, this one, your calculator will give you an error because there's none. And if you put in the cash flows for the NPV profile here, there are none, so you get an error. So it doesn't mean you made a mistake. It just means there's no IRRs. But you'd have to be sure that it's not your calculator making an error. It's actually that this is the case. And the only way you can figure that out is you actually generate the NPV profile yourself. Okay, so I'm going to leave you guys with that to work on, okay? It'll make more sense or mean more to you than if you do it yourself than if I give you all those answers. But you can ask me any questions you have during the week or next week. What I want to do now is introduce Unit 4. And for Unit 4, we're going to look at I'm going to move the lecture notes on top. So we're going to look at the lecture notes for Unit 4, and I have to give you the UR case. Give me a few minutes. Let's take a break. Let's just take a break for a few minutes. 5-minute break. So 7:30 we'll come back. Take a minute break. I'm going to prepare the UR case, and we'll just talk about it for 15 minutes. All right, can you hear me? I'm having some comments from YouTube. All right, you shouldn't have buffering. It's complaining that I'm not saying enough or doing enough. It's so weird. Doesn't like white noise, or not white noise, but what do you call that? Dead air. All right, so I don't know. I hope you can hear this. It's telling me that you're not hearing this, or it's buffering. So we're going to look at the UR case. I just posted it up. And the lecture notes for Unit 4 solve this case. And then I set up several exercises, different cases, where you can carry out the same sort of procedures to solve these cases to determine whether the project should be pursued or not. Right? So we can read through this together. We can start reading through it together, and I'll leave it to you to finish. And then you can read through the notes, and next week we'll just pick up from here. So by next week, I'm going to finish these notes regarding this case and then leave you with all those exercises to work on. I know you have Easter next weekend, but when we get back after Easter, we should just be looking at some of those examples and exercises, because then the test would be the week after that, I believe. So trying to think if that's the case. Let me verify what I just said. The second test date is okay. Yeah, we have a couple of weeks after that, so I'll have hopefully, yeah. So I'll be able to teach some of Unit 5 before the second test. So that's perfect. Okay. So I'm going to ignore what YouTube's telling me and imagine that you guys can hear me. No buffering. It's very frustrating to not know. I'm going to watch myself here to be sure. All right. So let's read this case. And what we're going to be reading for is to identify incremental cash flows for our analysis. So we're going to pluck those out of the story. Incremental cash flows are cash flows that accrue as a result of taking on a project or starting a project, okay? Pursuing a project or accepting the project, all the different ways to refer to the project. Okay, so we begin. UAir is a hypothetical leading American airline which transports passengers, cargo, and mail to 63 cities in North America. UAir provides jet services to cities located in the US, Canada, Mexico, Europe, the Middle East, and the Caribbean. Revenues last year totaled $5 billion. Should we include this cash flow as an incremental cash flow in our project analysis? All of the references, I've put them in Moodle. Why do you want to know about Unit 5? We're talking about Unit 4 right now. And I've mentioned that in Unit 4, references chapters 5 and 6. And I've put a deadline for completion by April 11th. We're on Unit 4. Okay, so $5 billion is the revenue stated for last year. And that's the past. Whether we pursue the project, well, if we pursue the project, that amount is not going to change. So that's not an incremental cash flow, correct? Let's continue. The airline is considering opening a new line to the Bahamas. Last year, UAir hired a consultant to develop and test a marketing campaign at a cost of $2 million. Is that an incremental cash flow? It's not an incremental cash flow either, because if I take on the project, it doesn't change the fact that $2 million were spent. All right, so that's not incremental either. So the blues I've highlighted are not incremental cash flows. This is actually known as, I'll put it in a different color. It's not incremental, it's actually a sunk cost. It's already spent. If I don't take the project on, I still spend it. If I do take the project on, I still spent it. Okay, so it's not incremental. So I'll add that. Let's continue. Given the competition in the airline industry, the consultant recommended to maintain the new Bahamas line for only 4 years. So that's important. I'm going to highlight that information. It's a 4-year project. Her predictions indicate that UAir can sell 16,000, 24,000, 30,000, and 22,000 round-trip tickets to the Bahamas during the first, second, third, and fourth years of the project, respectively. Are those incremental cash flows? Well, no, these are unit sales. Let's get the cost. Okay, so here it shows you that you will charge $2,000 per ticket. So this information together, what color should I use? I'm going to use red. So this information together with this information, what would that be? Is that an incremental cash flow? Darlene, yes, it is incremental. So this is going to be an incremental cash flow. It's incremental revenue. Got it? Let's continue. She forecasts that UAir chooses to launch the New Bahamas line. If UAir chooses to launch the New Bahamas line, it will compete with its flights to other destinations in the Caribbean. As a result, UAir will lose sales of 100, 200, 400, and 300 round-trip tickets to other destinations in the Caribbean during the first, second, third, and fourth years of the project, respectively. The estimated average round-trip ticket price to UAir's Caribbean destinations is $2,000. What are these amounts, and what do I do with this? Are these incremental cash flows? So this is going to be a set of incremental cash flows. They're incremental cash flows. That we're going to refer to as a loss. Okay, and a side effect of the project. So because we take on this project, our other projects, the other projects of the firm, experience a loss. So that needs to go into our analysis. So we don't just look at the benefits, we also look at the cost, right? The loss. And we're going to keep going. Thank you for participating, Dailene. UAir's CFO and his aides estimate that the company's average variable operating cost per round-trip ticket to any Caribbean destination, including the Bahamas, is $1,000. So what is this amount here? This amount is going to be the expense of flying people to the Bahamas and the expense savings of not flying these people to other destinations. So this actually is going to be incremental cash flow. And it's going to be an incremental expense. And we're going to add that it's going to be a cost savings in the case of the lost sales, because we don't have to spend money sending those people to other destinations. I won't say also, but you'll see in the lecture notes how we deal with that. Okay, I'm going over a little bit to just get through most of this. If you have to go, just go and you can watch this, the end of this video. I'm going to finish reading the case. It might take me another 10 or 15 minutes because I think that's the best way to do this. So then you can start reading the notes and you'll see I reference most of this case. Like it's pretty much a solution of this case as the lecture notes. Okay. All right, so the next, they note that since the airline has a vacant terminal, there's no need to rent an additional terminal for the proposed Bahamas line. The annual rental cost of a similar terminal is $10 million, and the CFO's team claims that having the vacant terminal will save the airline these costs every year. So what is that? What do we call that? Is that an incremental cash flow? So is this an incremental cash flow, this $10 million? Okay, Louise says no. What else do other people think? Okay, Dailin says yes. Okay. Anybody else to break or to I don't say break the tie, but okay, Sandra says no. Okay, good. Well, I mean, thank you. The answer is actually yes. It is. We're conducting a cash flow analysis. And in terms of economic cost, this is an economic cost. We already have a terminal, but it has a market value. The market value of the terminal implies even if we don't rent it out or do anything with it, we could have. So airlines need to put their planes somewhere, right? So usually they rent the space at an airport. So as a home base, these planes for Bahamas can't sit on the tarmac in our empty terminal. But that terminal has a market value, and because we're going to put our Bahamas planes on it, we can't sell it, rent it to anybody else. So the market values in terms of rental cost, we should have been able to rent it for $2 million. So that's actually an opportunity cost of using it for the UAir project. So yes, it's an incremental cash flow. It's a cost, an opportunity cost, an economic cost. So in each year, we're going to have to include $10 million as a cost. So everything was a cost that I underlined in red, except for the $2 million. So what I'm going to do is put that in blue. In the end, I went with blue and red. So I'm going to put that in blue here. And I'm going to call it sunk cost in blue, just so you see everything else is incremental. So we have incremental revenues, incremental cash flow as a side effect, incremental expense, and then I called it incremental cost savings from the side effect. I'll write that there too. And finally, the opportunity cost, which is also an incremental cash flow. So all the red are all incremental cash flows. And now we're almost done, kind of, reading the case. The airline's vice president of customer service and operations determined that for the predicted ticket sales, the airline must purchase 4 new airplanes. So they got to buy 4 planes. UAir's purchasing department has decided that the most suitable airplane for this line is the DC-9. The cost of a new DC-9 is $10 million. So is that an incremental cash flow? And what kind of incremental cash flow is it? Right, it is incremental. It's an incremental cash flow. What would you call it? Okay, so Thailand mentions expense or incremental economic cost. Actually, this is very specifically the initial investment, isn't it? It's going to be our initial investment, and it's going to be the capital spending. This is going to be what we invest. This is like our initial investment. And because we're going to expense it using the IRS rules for depreciation, so what we're going to do is, because when we buy equipment or a building for a project to pursue, either we expand to another location, we buy land, or we buy a building, or we buy equipment to duplicate services, or to expand to other counties or other parts of a city, municipality. When we do that, the IRS allows for depreciation, or like the wear and tear of equipment, in this case planes, in a way that we can actually claim a loss and reduce taxable income, and then experience tax savings. So this is a way the government encourages investment, right? And economic activity. So it gets people running business, and it rewards them with the ability to, even though it's like the planes are put into a 7-year depreciation, the planes, in fact, last for 30 years, it says later. Okay, so you're able to actually speed up and claim the wear and tear on the planes. There is a price to pay, and I'll talk about that in a second, but it allows you in those early years of the project to save in terms of taxes. All right, so this turns out in this case to have a huge impact in terms of the net present value. It makes the difference in whether you pursue this project or not. All right, so how does this work? So if you've never done anything like this, we're going to do it in this case, okay, in this unit. So what you're going to do is depreciate using the 7-year depreciation period. The maker's table I provide online, I'll show you where that is if you're still with me here. In the platform, in unit 4. I put them here. You see makers table. And the 7-year rates are provided here in this column, right? So you're going to see these numbers in the case. Now we're only going to use 4 years, the first 4. And you'll see that as well. All right, so it indicates that it's 28.6% as the appropriate double declining balanced appreciation rate. It uses half in the first year, and I'll explain that to you if you don't know about that. So then it switches to straight line depreciation in the 5th year. So all of this information is to tell you what's going on with that makers table and those results. 28.6 and half in the first year gives you 14.3 in the first year. And the reason why that's done is that it discourages, or we can say it encourages purchases or investments to occur all year round. There's no particular incentive for businesses to purchase equipment or to buy planes in December, right? So that they begin the next year with a brand new airplane, but can depreciate the value for a full year prior. Okay, so this half-year rule is to discourage companies from doing that. And you'll see it's about $10 million, right, to depreciate a $40 million worth of planes at the full amount of 28.6%. So that's why, to discourage that, they just give half the depreciation. You'll get the feel for that when you do the exercise. 28.6. Yeah, that's the rate. All right, so all this information is just to give you that the background to how the IRS calculates the makers table. And you're going to use that to calculate depreciation. Now, depreciation is not a cash flow, right? It's not, you don't see it changing hands. You don't see it coming and going. It's just something that's used. It's important, it's significant, because it helps you calculate tax savings. And that is a cash flow. You actually realize the tax savings. So you'll see how I deal with that as well. So depreciation is not an incremental cash flow, but the tax savings are. And I'm just going to make a note. So tax shields are the savings each year. We call it a tax shield. Or I'll call it a tax shield. Okay. So the next amount is $3,120,000. That's how much you can sell each plane for at the end of the project. Is that an incremental cash flow? Oh, Daylin asked me a question. Is opportunity cost the same as rental cost? Well, the idea of the opportunity cost is that because we're using the planes in the terminal, or using the terminal, to store the planes, we can't do other things. That's the opportunity cost. And it is going to be, yes, in terms of value, it's going to be the value of the rental cost, the rental amount. But we call it opportunity cost. All right, so back to this. Is this an incremental cash flow? are if we can sell the planes, is this gonna be an incremental cash flow for us? What do you think? In fact, it is an incremental cash flow, and we have a name for it. You can call it the residual value or the salvage value. Now, you need to compare the salvage value to the book value after depreciating the assets or the planes. And if you realize by selling the planes, if you sell the planes for more than the book value of the planes after depreciation over 4 years, then then in your taxes, you'll see you have a capital gain, and that will result in you having to pay taxes on that. If you sell it for less than the book value, you can realize a tax saving. So there's a tax treatment of this. All of it is incremental to it's an incremental cash flow, whether it's positive or negative. It occurs because you've taken on the project. So everything in red again, those are all incremental cash flows. And finally, we have what is known as net working capital. So here are, for the operations of this line, this new destination to the Bahamas, we need these amounts up front for inventory, cash, accounts receivable, accounts payable, and taxes payable for the day-to-day operations of the Bahamas line. By the end of the first year, we need this much, the second year, and so on. By the end of the project, we don't need anything. The project ends. By the end of 4th year, we don't need anything in terms of inventory, cash. So these amounts are amounts that are set aside just for this project, and they take from the other operations of the firm, right? From here, we need to calculate net working capital investment cash flows. That's what we're going to do. Net working capital investment cash flows, and these are also incremental. So net working capital is, it doesn't say, current assets minus current liabilities. So these are current assets minus current liabilities. Current in that they are short-term assets and liabilities, right? Within the year. Okay, so you would take these rows, inventory, cash, and accounts receivable, are all current assets, and minus, I'll put it in black or blue, minus accounts payable and accounts, takes taxes payable. So this is also going to go into analysis. So what my approach is going to be to solve this, to calculate the NPV of the proposed line using a discount rate of 10%, I'm going to separate all this information into 3 parts. Income, investment, and the present value of tax shield. So present value of income plus present value of investment plus present value of tax shields to calculate the net present value. That's going to be my approach. So you need to separate this information into the 3 parts, and that's what you'll see in the notes and how I justify using this approach. Okay, so it's 8:07. I'm going to leave you work on Unit 3 this week. And when you finish, hopefully before next time I meet with you, you'll be able to look at the notes somewhat and see what I did and why I did this approach or used this approach to compute the NPV and how I did it, right? How I took all these and divided it into the 3 parts. So I'll leave you with that. So have a good week. Keep in touch. I'm going to add into Unit 4 exercises on capital budgeting. More cases and solutions for you to look at. So I hope you can work hard this week and we can make some progress before the break. Buenas noches. Thanks for sticking around, and I apologize for those that I stayed longer and I started late. I hope this is helpful. Okay, bye for now.